Hey there. My video today is what the IRS considers reasonable compensation. And so looking at that question, what is reasonable compensation? It's a common question raised for privately held companies where the owners are working in the company as employees. Legally, the owner has the power to control the amount paid to them for compensation, often, unless they're a minority owner. But this power that we're talking about, it comes with additional tax scrutiny. This is true for both a C corporation, what we consider the double taxed entity, and the flow-through S corporation. Now, shareholder compensation becomes an issue in both of those structures, but it is motivated by opposite incentives. And after the 2017 Tax Act, there is additional consideration that we haven't yet seen guidance on, but that I'll kind of throw out there with regarding the C Corp structure in a different light as well. So in the C corporation structure, if we focus on the traditional issue, the closely held business is going to seek to avoid double taxation that occurs when the company has income. And what I mean by that double taxation is the company has income, it's taxed, the company pays tax, and then when that income is distributed to the shareholder as a dividend, the shareholder pays tax again on their personal tax return, and that's the double tax. The corporation and the shareholder each pay tax on, or each taxpayer is going to pay tax on the corporation's income. So in that structure, the shareholder has an incentive to pay or perhaps overpay themselves in the form of employee compensation. Because when the company pays employee wages to the shareholder, those wages are treated as an expense on the company books, and therefore they reduce the corporate income that is subject to tax. The owner still pays tax on that income because they receive it as an employee compensation. However, this tax plan has reduced the double tax on that income down to a single layer of tax on just the compensation. The company is not itself paying tax on that income anymore. So what's the problem with this strategy? Well, claiming a deduction for that compensation requires that the compensation is considered reasonable. And historically, the IRS has denied this deduction to companies when, in their judgment, the compensation being paid to an owner is considered excessive. Courts have upheld the IRS position in an established doctrine known as the constructive dividend, where unreasonable C corporation shareholder compensation is being reclassified as just being a dividend. Unlike compensation, dividends are not deductible against corporate taxable income. Well, that's the traditional issue with C corporations, but since the 2017 Tax Act, we have seen a decrease in the C corporation tax rate down to 21%. So what we're now considering, or seeing some tax planners look at, is can you be a service provider who incorporates your business as a C corporation, not pay yourself any wages, and come out ahead in some cases in federal tax? And it really depends on the tax bracket you're in, whether that might even work at all when you compare a 21% corporate tax rate and perhaps a 15 or 20% dividend rate. And then you have the net investment income tax on top of that. So there's a lot to that question that mathematically may or may not work out. But if you suppose that it does work out on the margin, the next question would be, well, are you allowed to do that? Can you just not pay yourself as a service provider in your company any wage at all in a C corporation? And because all of the court cases and all of the doctrine on this has been geared in the other direction to prevent you from overpaying compensation in a C corporation, the answer is we don't really know. And so I'll just leave it at that, but I'll compare that to what we know about S corporations. So if I go back to what we do know, is what happens in the S corporation scenario. You can see where there might be a basis for extending that over and starting to look at, well, will there be additional regulation or guidance that prevents you from underpaying wages in C corps as well? Because that's what happens in the S corporation structure, is that shareholder compensation for S corporations is also scrutinized, just like it is for C corporations, but for opposite reasons. In the S corporation structure, shareholders have the incentive to avoid payroll taxes. Social Security and Medicare taxes is what I'm talking about. These are also called self-employment taxes. They're collected by employee, they're collected through employee payroll via the payroll tax withholding on wages. And so if your owner is an employee who gets a W-2, that's how they are paying Social Security and Medicare taxes. But if you are self-employed, then you pay your Social Security and Medicare taxes on self-employment income. When you're an S corporation owner, you're supposed to pay yourself a W-2 wage, and that's how you pay the Social Security and Medicare tax, because S corporation profits are not considered self-employment income. So you wouldn't pay Social Security and Medicare tax on the S corporation profit. So the strategy that comes out of that is, well, maybe you can avoid your Social Security and Medicare taxes altogether by just not paying your S corporation owner any wage whatsoever, right? Well, wrong, because what the rules say is that if your owner is working in the business, then they are required to receive a reasonable wage for their services. So this is going the opposite direction than the traditional C Corp analysis. In this case, the IRS would be looking to see, do you pay your S corporation owners enough wages? And that requires additional analysis and judgment, just going in the other direction. Establishing reasonable compensation in both the C corporation and the S corporation scenarios, as I said, is a judgment issue, but we do have some idea about how the IRS looks at it. In 2015, for example, there was a field attorney office advice memorandum sent to the IRS revenue agents. It's legal advice on to the revenue agents on how to deal with reviewing the question of reasonable compensation. And they had like an 8-point list of things to look at, but really what it comes down to is, what is the company's procedure for determining employee wages, and did they follow that same procedure for the owner? And is that procedure market based? Is the owner getting paid a wage that is reasonable in comparison in their geography or their location and in their industry to what other people doing similar job functions would get paid? That also takes a look at general economic conditions of the time, looks at the size and complexity of the business. Now they also look at questions of, let's make a comparison of the wages being paid to the cash flow available, right? So if the company has cash flow available, but it's claiming that it can't pay or doesn't pay the owner wages, that's suspicious. And if the company has cash flow available and pays the owner distributions but no wages, that also would be suspicious. So having reasonable compensation is really a function of what would a market analysis say the compensation should be, and does the company have the ability to make that payment? If the company doesn't have the ability to make that payment because the company wasn't profitable, there's no rule that says that a company that doesn't make any money must pay their owner's wages, right? If your company's not profitable, if it doesn't have the cash flow, you don't have to pay the owner a wage. But you can't then turn around and pay the owner a dividend either, right? Because if the company's not profitable and doesn't have cash flow, both should be true. You can't pay the wage, but you can't pay a dividend. Now, in their list or in their discussion, back in that 2015 field advice memorandum, legal at IRS goes on to note that if a taxpayer is paying more compensation now to an employee to make up for low compensation in prior years, then they should reevaluate the prior years. So that part's a little bit iffy, because that raises the question of, well, what if there was no money to pay that compensation in the prior years? Is that really fair? And again, I would say that while the IRS legal memorandum may say that, when you look at the court cases, the courts have sided with the IRS in cases generally where the cash was available. And when there's not cash available, I'm not aware of a case where the IRS has successfully been able to force a company to pay a wage when there was no cash to do it in the first place. The IRS also points out that employee compensation includes bonuses, deferred compensation, and benefits in addition to regular salary. So you got to look at the whole package comprehensively, right? It's not just were they paid in cash at that point. So best practice in defining your shareholders' reasonable compensation is to document how you came up with the compensation, and I would actually use the points that the IRS gave. So find out what those 8 points are, and then use those points to document your conclusion on each of those points. Involve your HR people, right? If you have HR in your company, or if you have somebody in your company who usually does the hiring and they have some procedure or process checklist they use in going through the hiring process with other employees, have them use that on the owner employee as well, so that you can use the same exact documentation you would for any other employee. I think that puts you in pretty good standing to have done it right in terms of having reasonable compensation. Okay, well, that's it for this video. I'm going to get back to gardening. See you all later.